Welcome everyone to another episode of Mere Finance. Today we're going to talk about higher for longer, how the Fed raising rates so fast and keeping them higher for longer is going to show tremendous debalance in the equity risk premium. So let's start. For decades, we saw fixed income very unattractive. But the robust equity market, fueled by a low interest rates environment, made fixed income, as we said, very unattractive. But however, as the central banks around the world are combating inflation, yields are finally back as an alternative for investment the way it should be. So you see here, high grade and high corporate high yield now show some of the highest rates in decades. You can see in the high yield department all the way from 7% to 13%. In the investment grade from 4.9 to 5%, which is around 10 bips more than T-bills. But this is where it becomes very interesting. As term premium then plays an important part here. So term premium refers to the compensation investors demand for holding long-term government bonds. So investors are seeking more term premium with higher inflation and other near-term risk on the horizon. So basically what we think is, since the Fed is going to hold the rates higher for longer, then this brings volatility down, and then investors are more prone to hold their investment. So let's check. We can see here, this graph, how it seems like the market is now pricing 5.125% dot plot by July. You see 7.26 is 5.13, so very, very close to what we see, 5.125. But cuts are priced already very soon after. You see in the lower graph how it peaks in July and then it starts dropping. So the Fed has definitely won the battle on peaking rates higher than 5%, but not the battle on the high for longer narrative yet, which is where I think is the equity markets are incorrect, because we expect this to keep going up. And this is how it affects the equity market. So your cost of capital, your weighted average cost of capital, is your cost of debt plus your cost of equity. So here we have cost of debt is the risk premium, which has gone up, because as your interest rates, your risk-free rate goes up, your risk premium has to go up. So investors going then into equity instead of holding fixed income. So risk premium goes up, your beta, and then your risk-free rate went up. This makes cost of equity way higher than cost of debt. Then your average debt yield times your tax yield, that's your cost of debt. And your average debt yield has gone up, and your tax yield remains similar. So people will rather go into debt, or companies will rather go into debt, because your tax shield will protect them. So this is clear. As your cost of debt goes up, your cost of equity goes up higher, which is where we see the big issue with equity premium risk. Where do we see it? So basically, earning yields is calculated as the stock price divided by earnings. We can see it's at 4.58, and treasury bills in the less than 1 year, so like 3 months, 6 months, and 9 months, are yielding similar numbers, are yielding like 4.5. So then why you should take that equity risk premium if it's taking way more risk, higher volatility, when you can just park your money in one of the safest assets in the world, which is government bonds. So you can see, it is the next slide. The risk premium is at decade lows in U.S. equities. So the compensation, as we said, is earnings yield minus risk-free yield. So as your risk-free yield goes up, your earnings yield, doesn't go up as high. So then your risk premium starts to go down. And you can see it here. Your risk-free yield went up. This is the blue line. Your earnings yield is going slightly down as your black one. So then your risk premium just gets completely cratered. So in other words, some traders said that the best way to play this is to long the TLT, which is the long treasury ETFs, 20 plus years, and then short the S&P 500. However, can you see last year, the S&P 500 until now is down 9%, while the TLT is down 24%. So I think this could be a possible trade to make, as the narrative higher for longer will come to place even though the market doesn't believe, the equity market doesn't believe. And this is something that we need to talk about. In mid-2006, the Fed paused its hikes at around 5%. So for the next 9 to 12 months, the economy did decently well. It held well, even at higher rates. The S&P 500 went up 20% from its local lows. And then what happened? 2008, when everything crattered. So maybe for now, the equity market hasn't realized they're in big trouble with the equity risk premium. But I think for the next decade, equities markets don't seem to be the way to go from every macroeconomic perspective. So thank you for watching. Hope you give us a follow. I will wait for next week for the new episode of Mere Finance. Thank you.